Due of her performance, investors like ARK Investments CEO Cathie Wood. Viewers of this station are familiar with Tesla, the pioneering electric vehicle business. Wood has long been a Tesla bull, with Tesla shares dominating her investing company's fund. Wood traded most of her Tesla shares and bought Teladoc shares, which she expects to outperform Tesla by 100 times. These actions make investors doubt her trust in the brand outperforming Tesla. Her company holds 10.95% of the brand's shares, and she's strongly supported the digital healthcare brand's growth. Is Teladoc better than Tesla, and what's next for digital healthcare? Watch to find out. Cathie Wood oversees multiple notable ETF funds with a reputed worth of roughly $250 million. Her investment lost a lot in 2021, but she believes the fund is undervalued and due for growth. Cathie Wood has pushed for investment in disruptive growth companies. These companies must also have a 5-year growth outlook that doubles their value. Wood loves cryptocurrencies, AI, renewable energies, the genome, robotics, 3D printing, and space exploration. She has backed everything that is shaping the future. Her investment strategy may seem risky today, but she said it's similar to Warren Buffett's, except he finds companies valued now, while she finds companies valued tomorrow. In the previous year, social distancing and public health rules have reduced the amount of in-person doctor's appointments and other health visits, making Teladoc a crucial telehealth AI analytics firm. We believe it will remain significant beyond the pandemic because it is cost-effective, efficient, and convenient. Recent years have been great for ARK's exchange-traded funds. ARK Innovation ETF, the company's flagship ETF, returned 175% last year. The ARK Genomic Revolution ETF, which invests in stocks and gene-editing healthcare, returned 186% last year. Such results are hard to dispute. We all know Cathie Wood is positive on Teladoc shares. The ARK Genomic Revolution ETF's largest holding is the telemedicine company with 7%. It is the ARK Innovation ETF's third largest holding, accounting for 6.5% of the fund and the only one below it. In fact, ARK Invest owns over 11% of Teladoc shares, bought at $148 to $172 each. Even though the stock is down 75% from its peak, the firm is improving. Tesla set new highs with faster growth in 2019. On the surface, Teladoc Health and Tesla share only their first two letters. Both are industry leaders. Two stocks are also popular. Cathie Wood's ARK Invest ETF has drawn investors like us to Teladoc shares. Over the past 5 years, her disruptive innovation company has returned over 500%, outperforming the S&P 500, which has returned 92%. As the company has chosen growth companies successfully, this is expected. We think Teladoc Health was chosen for its unique business model, which matches Ms. Wood's investment attitude. Investors like to follow investment managers and billionaires to obtain suggestions for where to invest. While Warren Buffett is famous among value investors, Cathie Wood may appeal to risk takers. She recently sold Teladoc shares and bought Teladoc Health shares. Even if the healthcare company's stock has been falling since 2021, should investors acquire shares now or risk losing them to Amazon? Teladoc's consensus 1-year price target might rise over 50%. Tesla isn't loved by Wall Street experts. Average stock price aim is lower than current share price. Tesla's stock price might drop 90%, according to one expert. Meanwhile, analysts suggest Teladoc's rise has only begun. Most analysts just consider the near future. How do Teladoc and Tesla compare long-term growth? Teladoc wins, in our opinion. Amazon will offer telehealth to employees and businesses worldwide, challenging Teladoc's market dominance. The $1.5 trillion firm can undercut providers to persuade consumers to try its service. Amazon's not the only threat. Cigna announced it would buy MD Live, another telemedicine business, earlier this year. Like CVS Health, the insurance offers virtual doctor appointments on its website amid the trend. More rivals are expected due to the industry's size. This means one of two things. Due to the sector and business model's potential, new competitors keep developing. Teladoc is ahead and will keep rising because the competition can't catch up. Telehealth could be worth over $70 billion by 2026, growing 17.7% annually, according to a research and market survey from last year. Everyone needs healthcare, regardless of age or socioeconomic class, so profits may hit everyone. Telemedicine's bright future is based on technology that seamlessly integrates patients' medical history, real-time health, medical insurance, and financial data to support professional decision-making, improve health, and save money. And experts said doctors will eventually have access to data, including insurance benefits based on a patient's health profile in addition to lifestyle. They stated that as more data is added to better healthcare decision-making, the number of things computed becomes limitless. These technological and data integration accomplishments will not be without challenges, but Teladoc's expansion will be plagued by fewer problems than Tesla's. The stock is costly and risky. We recommend Teladoc as a top health firm to invest in. It's the industry leader, and given its size and diversity, it's unlikely to change soon. We agree with Cathie Wood, hedge fund manager or individual investor. Teladoc may work for you. Teladoc faces a lot of competition, but investors haven't seen how well it could do Livongo Health over a year, let alone the chances two companies could find together. The price has fallen since early 2021 due to concerns regarding Teladoc's acquisition of Livongo Health and its pandemic stock status. Revenue and visitors have increased at Teladoc. Company forecasts have increased. This stock has lost about 50%. Why? Patients would eventually abandon virtual medical sessions and return to their doctor, investors said. Not yet, and it's unlikely to happen. However, NIO, Xpeng Automotive, and Li Auto may trouble Tesla in China. Competition will be tough for the company. Tesla has dropped its vehicle costs, but it doesn't mean they're ready for an attack. Even legacy OEMs have set aside considerable money to defeat Tesla. Teladoc isn't concerned about Amazon or other competitors. Over 40% of Fortune 500 companies and 50 U.S. health plans are customers of the company. This platform has more features than its competitors. Teladoc has a Net Promoter Score above 60, indicating user satisfaction. Outstanding NPS scores are above 50. Teladoc appears to be better positioned than Tesla to defend its area. We think the virtual care leader is a good investment and may outperform Tesla due to its higher value and growth prospects. As Teladoc forecasts consistent but slower growth next year, it seems like a marathon. Management expects 25% to 30% revenue growth and 23% to 33% modified earnings before interest, taxes, depreciation, and amortization. Teladoc's growth may exceed the industry until 2024. Teladoc aims for 25% 30% compound yearly growth. The U.S. addressable market exceeds $261 billion. By recruiting new members and expanding programs, the organization can increase revenue. All of this shows future growth potential. Cathie Wood believes in Teladoc view. Do you think Teladoc will outperform Tesla? Leave a comment. We want your opinions.